Most new traders start trading by learning strategies of other traders. I began my career as well. But many traders ask, how do I get started with my own trading strategy? The good news is that creating your own trading strategy is easy. The bad news is creating a profitable trading strategy is hard. My name is Isma. I do welcome you back to my channel, and in this video we're going to be looking at the 10 steps of how you can create your own trading strategy. Step number 1, form your market ideology. Before you jump into creating your own trading strategy, you must develop an idea of how the markets work. Most importantly, you need to answer this question: why do you think you can make money from the markets? So it's important you definitely go deep into reading and understanding the technicals, the fundamentals of the markets before you literally start creating your market, your trading strategy. So we find it important, we find it most important to know and understand the details, the technicals, the fundamentals, the mechanics of the market before we can literally start creating our strategy. So it's important that you basically understand the technicalities, the structures of the markets before you start creating your own trading strategy. So first, understand this deeply and understand them deeply and know what the markets are. Answer the question as to why you think you can make money out of the markets, and then by that, then you'll be in position, or that should literally make it the first starting point for you creating a trading strategy. And also, let us also forget about the get rich quick money scheme in the forex market, because that's not about forex. Of course, at the beginning you will find challenges, you will find barriers, okay, but still the point should be consistency. With consistency, everything becomes possible. So basically form your market ideology when you are to create a trading strategy. The second step on creating your market strategy is to choose choose a market for your trading strategy. So you basically need to know, yes, I'm creating a trading strategy, but then which type of market am I creating this particular strategy for? Am I creating it for currencies? Am I creating it for equities? Am I creating it for indices? Am I creating it for options? Am I creating it for futures? So before you literally start creating the entire trading system that you're going to be using, it is important that you at least know which type of instrument are you creating this strategy for. So the second step that you should mind after the trading ideology or forming your own trading ideology, the next thing should be knowing the market, the type of market that you're literally creating this strategy for. So it is important because different market structures or different market asset classes, different market asset classes do have different characteristics, different structures, different formations, and forth. So if you're creating a particular one, you need to extensively go deep into the particular instrument that you're looking forward trading, such that you are on the right track. You form an appropriate trading strategy for the instrument that you're trading, because we really do not want to find you trading using different trading strategy, okay, that is relatively relating us to the stock market, but then you are literally trading the forex market. So you need to know the type of market that you are literally creating this trading strategy for. So the third step of creating your own trading strategy should be choosing a trading time frame. So you should choose a trading time frame that you're going to be trading for, because we do have different types of trading time frames. You can of course, literally someone can trade the 1 minute, 5 minutes, 15, 30, for 1 hour, 4 hours, daily chart and monthly chart, weekly, daily, monthly chart. So we have different types of time frames. So you need to know that if you are creating a particular strategy, you need to know the time frame that you're literally going to trade in, because it's at the end of the day the time frame that will reflect or determine the type of trader that you are, the style of trader that you are. So knowing if you're a scalper, then it's important to choose relatively those time frames that are smaller on the trading on the time frames that we do have on our trading platforms. So choosing knowing the time frame to work with when you are trading is also something that we should take note of when we are creating one. So if you are a scalper, there are time frames that you're supposed to be trading. If you are an intraday trader, that's your style, and then there are time frames that you're supposed to be trading. If you are a swing, there are time frames that you're supposed to be trading in. If you are a position trader, there are time frames that you're supposed to be trading in. So knowing the time frame that you're trading in is another aspect, another step in creating our trading strategy. So every trading strategy should literally have the particular time frame. So we do not expect someone creating a trading strategy which has no clarity on the time frames to be traded in. So let's have choose a trading time frame that you're going to be trading in before you literally start trading or creating your trading strategy. Step number 4, choose a tool to determine the trend. So we need also, because when we are trading, when we are choosing a trading strategy, we need to determine a particular tool that we need to always use when we are determining the trend, because it's during this particular period whereby you'll notice someone is using trend line, someone is using moving averages, someone is using support and resistance, someone is using supply demand zones, so someone is using other relative indicators, oscillators. So you need to be particular on the instrument, on the tool that you choose when you're identifying the trend. So having a tool in your trading strategy that helps you determine the type of trend the market is, okay? So you need to choose a particular tool that you're going to use, a particular technique that you're going to use to identify the type of to identify trends in your trading strategy. So we have a couple of these, but then it's important to choose particulars that will help you come up with or identify the trends in the market. So it can literally be purely price action, whereby you're looking at the higher highs, higher lows, and joining them to come up with a trend line, whereby we look at support and resistance, or you can simply use moving averages, or you can use simply the Ichimoku or Ohio indicator, or you can use other tools. There are a couple of tools. So it's important you choose a specific tool that you think will help you better define the trend in your trading strategy. So identifying a particular tool to determine the type or to determine the trend in your trading strategy is another key step. And for this case, it is step number 4 that we're going to consider as where to find the tool of determining the trend. So this is another important aspect on creating a trading strategy. Step number 4, define your entry trigger. So you need to know, when should I enter? Because this is what usually happens before you literally come up with a trading strategy. There are certain things that we should consider as paramount, as important, and for this case, these are things to do with entries, exits. So determining your exit, okay, the trigger for the exit should be an aspect. In other words, if let's say we have A, that's condition. If your entry should be having 3 conditions, condition A, B, and C, then after you can have an entry, then C should be the trigger for the entry. So knowing when to enter is another aspect of a very important component on creating a trading strategy. Even with the right market context, you need an objective entry trigger. It will help you enter the market without hesitation, both the bar and the candlestick patterns are useful triggers. If you prefer indicators, oscillators like the RSI, stochastics are good options too. So you need to know, yes, after all, I'm using indicators, after all, I'm using oscillators, after all, I'm using price action. What should I literally look out for that will determine my entry point? Because now you're looking at something that can yield you good entry point. So you should always have to look at something that we literally think is going to make us a perfect entry and it will yield a high quality trade. So it's not just a matter of you coming into the markets and, you know, after I've seen this and this, let me just enter. So you need to have entry triggers, okay? So, and these will help us yield high quality trades. High quality trades are trades whereby all the conditions to be determined for the entry within the place are observed. So we can go to the next step. Plan your next trigger. You need to plan how to exit when things go wrong. The market can go against you, causing you losses beyond your imaginations. Having a stop loss is critical. So after going in for the next trade, rather after executing an entry or having an entry, observing your entry triggers, then it's also important to know then you've entered, you have a position, then how do you determine coming out of this trade? What are some of the observation? What are some of the conditions? What are some of the criteria that should be seen, should be in place for you to exit a particular trade? So here we find it helpful by using stop losses. Where are you putting your stop loss? Why are you putting a stop loss? You're putting a stop loss at a certain point with risking after risking a certain amount of money. How much could really that going to be? So all these are questions that should be planned, okay, before you exit a trade. So the stop loss determines the risk and will always be our exit point, and using a stop loss is highly a privilege when we are doing this. Step number 7 is to define your risk. Once you have your entry exit rules restored out, you can work on limiting risks. So after knowing where you will be coming out of the trade, then the next thing should be yes, I've planned where I'll be exiting from, but then the point should be, how much will I be risking? What will my stake be for every particular trade, or for the general planning of your risk management, money management on the entire portfolio of your account. So you need to know how much you should risk on a trade, how much you should risk in a day, how many trades you should do. All this relies on you defining your risk. So it's important you define your risk before you literally can go into trading. So double your position size and you will double your risk. Watch your position size carefully. So this is something to do with you, of course, knowing position sizing, how to calculate your position size. That's your lot size. How do you calculate it, or the volume, or the stake on a particular trade? All this relies under you defining your risk. And step number 8, write down your trading rules. At this stage, your trading strategy is simple. You might be able to memorize the trading rules. However, you must still write your trading rules. So after all what we have gone through, it's now important now you start scripting. So it's better you write the procedures, the steps that you should take, okay, before you enter, during entry, and then after you've entered a particular trade. So this is what now we refer to as a trading strategy, writing these rules. Okay, a trading strategy, someone might think it is something, you know, the indicators, the oscillators, but then no, these are basically scripted principles to be followed when you are when you are starting to trade, during and after trading. So all that should be stipulated down and followed accordingly when you are creating a trading strategy. So follow these rules, write them down, and then keep them with you, keep them at your fingertips, know them and follow them. After writing your rules, the next step that we should follow, which is step 9, backtest your trading strategy. After knowing, of course, the indicators to use, the time frame, defining the risk entry, and all that we have just discussed in this video, the next thing should now be backtesting. So backtesting is basically, of course, going to the history and apply the rules that you've written down to see if they really made sense, to see if they really made good entries based upon what you are anticipating to be in the markets, and then check out and see if the trading strategy is profitable or not. This can basically be done manually or by use of code or by use of softwares and forth. So backtesting will literally help us to tell to which percentage do we now expect to be having a positive percentage and a losing percentage. So if you literally find it that most of the times you're having more profits than the losses, then it means that this is a perfect and a wonderful strategy to use. But still, you need to be subjective to changes because the markets are dynamic. So we should not stick at only one thing where there is need, because previously if you may do backtesting and things are really working out, but after a certain period of time, fact being that the markets are dynamic, and you may find that what you had literally was working for you, it now no longer works out for you. So this is why we say that you should also be subjective to changes, fact being that the markets are dynamic. So we need to be subjective and always improve our trading strategies over and over, because the markets do keep change. The last step should be plan how to improve your trading strategy, which I've literally just mentioned. Always improve your trading strategy. The markets keep changing. Always be subjective to changes in your trading strategy. Don't be hesitant. Don't be static on a particular, because you'll be like, some people may be like, this is my trading strategy, and since it's my trading strategy, things should always be the way they have been, and so they should be the way they have been for the markets do keep change. Always be subjective to changes in the markets, and by that you now be in position to have created a wonderful and a perfect trading strategy. Conclusion: follow the 10 steps above and you will find yourself with the basic trading strategy. This strategy is not a holy grail, but it is formed with your experience and according to your trading style. Keep working on it and you will stand a chance to succeed. So basically, those are my remarks. If you really love the content, share, subscribe, and also like other social media platforms of ours. Thank you so much. I do sign out. I stay Isma. Bye.